Hi, I'm Dr. Drew and welcome to my YouTube channel. This is a channel not on medicine, but on all the other aspects needed to live our medicine lives. Today, we're going to be talking about the concept of the management expense ratio. And why is this an important concept to know in the case of stock market investing? So what is a management expense ratio? It is essentially a measure of the costs associated with managing an investment fund. It includes the management fees, administrative costs, and other expenses related to running the fund. The management expense ratio is expressed as a percentage of the fund's assets and is deducted from the returns of the fund. Now, why is this important to know for physicians? Well, I would say a vast majority of the media and the push in the index world and stock market investing focuses on this one number, even though in my opinion, this is one skill set you would need to know or be able to find out where you can get this information in order to be able to enter the world of stock market investing and how mutual funds and index funds and various other classes are affected by the management expense ratio. So investments are an important part of many people's financial planning, and physicians often find themselves in a position where the MER is higher because they're involved in a physician-driven mutual fund, for example. So you can see here, I've given an example, and this is covered in kind of various of my own way to educate myself. So if you invested $100,000 in the 1960s and put it into the S&P 500 index fund in 1960 and didn't add any single amount and just let it ride the entire path until 2020, if you had no fees associated with it, you would have an amount of approximately $37 million. And that seems like a very high amount. And this is just math. I'm not essentially to say that the past returns are not an indicator of future returns or whatever it is. But essentially, if you had no fees, you invested $100,000 in the 1960s, and you didn't add any single amount, you didn't withdraw any single amount, you just let it ride until 2020, so approximately 60 years, you would have about $37 million. Now, the average Canadian pays about 2% in fees, so you could see that at the 2% fees mark, the actual amount now, because it's been withdrawn from your portfolio of $100,000 invested in the 1960s, would now be about $12 million. So you had the potential of earning $37 million, but you only have $12 million right now. So that's a 67% difference in what you have earned or what you could have earned. And so that is why this whole drive around index funds, driving that management expense ratio of fees as low as possible. If you were an index fund, the fees could be anywhere in the 0.06 or to 0.1%. I mean, I've chosen 0.5%, which still creates a 25% difference. While if you're in the 2% range in mutual funds and things like that, you would have a 60% percent difference. And a lot of books have been written on this: Beat the Bank, A Random Walk Down Wall Street, Common Sense Investing by John Bogle. So, I mean, I can name books all day, every day, but this is the reason why the MER is so important. Lower MER means higher returns for investors, and physicians who understand this concept can help essentially their own portfolio and make informed investment decisions. So how can physicians use the MER? Well, in this case, when you're designing your own portfolio or your financial advisor is putting you in a portfolio, this number can be easily found on the fund fact sheet. So when you're being put into an investment vehicle, look at the fund fact sheets, look at the MERs. And I would say with some level of education, your goal is to drive the MER down. But having said that, certain investments like hedge funds or real estate investments or mortgage funds, the MER of that won't be able to be driven down because a lot of expenses, especially with compliance and all those things, have to be taken into account. And it is at the end of the day a business when you're trying to run an investment fund. So you do have to kind of work with the company or the sponsor or your financial advisor on that. But hopefully, for the purposes of understanding this concept, by choosing funds with lower MERs, you can essentially maximize your investment returns and achieve your financial goals. So in conclusion, MER is an important concept for physicians to understand when designing your own portfolio. It can help you make informed investment decisions, choose the investments with the lower MERs, with the higher returns, and reach your financial goals faster. I encourage you to either learn more about this, read the fund fact sheets, or speak with the financial advisor, or attend educational seminars to understand more about this concept. So a few action items if you'd like to take back control of your time and money and follow the exact frameworks that I discuss here, then you can check out the link in the description below. I make these videos because my passion is to help 10,000 physicians fight burnout and become better passive physician investors. So I create these videos as a legacy. Come and join my community of like-minded physicians in my free Facebook group, where I share cheat sheets, resources, and everything in between so that we could live our best medicine lives. Thank you very much for listening. Thank you for taking the time to educate yourself on these concepts, and I look forward to seeing you in the next episode.